Stop what you're doing. If you own or are looking at AI hardware stocks, you absolutely need to see this fundamental breakdown. Last week, I ran Seagate Technology through 5 different strict valuation models and 2 legendary investment checklists, and what I found completely shocked me. Welcome to this explainer where we're going to unpack a massive contradiction at the heart of one of the market's hottest artificial intelligence plays. Because right now, evaluating Seagate is like looking at a shiny new sports car that might just have a ticking time bomb hidden in the trunk.
Let's start with a seriously jarring statistic. Over the last 5 years, for every single time a Seagate insider bought their own stock, there were 130 insider sales. One purchase, 130 sales. That is over $400 million unloaded by the exact people running the company. I know, that triggers a massive fear for everyday retail investors, right? Nobody wants to be left holding the bag while executives quietly cash out. Yet somehow, the smartest institutional money in the room is piling into this exact same stock like there's no tomorrow.
By the end of this explainer, you're going to know exactly if Seagate is a brilliant Buffett-style value buy or a classic Peter Lynch value trap. And you'll have a clear, actionable framework you can steal for your own analysis. We're going to cover the massive AI storage boom, Seagate's undeniable tech moat, their wildly polarized financials, that tug of war between institutions and insiders, and finally, a direct head-to-head comparison with Western Digital. Let's get right into it.
The AI storage boom and feeding the chatbots. We constantly hear about the fancy microchips powering AI, but think about it for a second. Where exactly does all that newly generated data actually live?
To really grasp the sheer scale of the operation required to feed this boom, just look at Seagate's sprawling global manufacturing footprint across Asia, the Americas, and Europe. This physical infrastructure allowed them to ship a staggering 199 exabytes of data storage in just the third quarter of 2026 alone. This isn't just some fluffy software story. It is a massive, incredibly capital-intensive hardware reality. And the demand side of this equation is just wild. NVIDIA's Jensen Huang recently pointed out at CES 2026 that storage is the largest unserved market out there. It makes perfect sense. AI chatbots are handling billions of prompts every single day. We're shifting from periodic AI training runs to continuously generating mass-capacity, multimodal data, think high-res images and heavy video. Data centers absolutely need physical space to put it all.
Well, this paradigm shift translates directly to the bottom line. Seagate's data center revenue has absolutely exploded. It now makes up roughly 80% of their $3.1 billion Q3 revenue. That specific segment alone is up 55% year over year. The AI infrastructure build-out is completely reshaping their entire business mix. Section 2. Seagate's Tech Mode and the HAMR advantage. Look, Seagate isn't just passively riding a wave here. They actually possess a distinct, highly quantifiable technological advantage over the competition.
That secret weapon is HAMR, which stands for Heat-Assisted Magnetic Recording. Essentially, it's a breakthrough technology that significantly cranks up aerial storage density. In plain English, they can pack way more data onto the exact same physical disk. We're talking 30 to 44 terabyte hard drives without making the actual units any bigger. For hyperscaling data centers, this dramatically lowers their cost per terabyte. It's a total game changer.
And this built a massive competitive moat. Seagate is currently the only manufacturer out there shipping these HAMR drives at scale with their Mozaic 4 Plus platform. This hands them a critical 12 to 18-month first-mover advantage over rivals who are frankly still scrambling to catch up. Competitive launches aren't even expected until the back half of 2026. Meanwhile, Seagate is already targeting 50 terabyte drives by late 2027. Because of this massive lead, Seagate has insane pricing power. Their CFO, Gianluca Romano, stated that the vast majority of their nearline capacity is already fully allocated for the next 4 quarters. They've secured build-to-order contracts that lock in their revenue predictability all the way out into 2027 and 2028. They are quite literally selling everything they can possibly produce.
Section 3. Record profits, massive debt, and the financial whiplash. Because yes, this pricing power creates phenomenal short-term earnings, but when you look closely at the balance sheet, prepare yourself for some serious financial whiplash.
On the surface, the fundamental metrics are spectacular. You've got 44% year-over-year revenue growth, record-breaking gross margins hitting 47%, and nearly $1 billion in free cash flow in a single quarter. If you just stopped reading the SEC filings right here, you'd think this was a flawless, untouchable business.
But hiding immediately underneath those shiny record profits is a highly leveraged, incredibly fragile balance sheet. They're burdened by over $5.3 billion in total debt. And get this, $1.7 billion of that was borrowed at crisis-era interest rates of 8 to almost 10%. To make matters worse, due to massive historical stock buybacks, the company is technically operating with negative stockholders' equity of $453 million. Yeah, negative equity.
So why does this matter to you? It creates a high-beta, leveraged cyclical vulnerability. The hard drive market is historically deeply, deeply cyclical. If there is any sudden drop in AI capital expenditure from the major cloud providers, it could trigger severe consequences for a company running on such a razor-thin financial cushion. It is essentially a high-wire act.
Section 4. Smart money versus insiders, a diverging consensus. This deep contradiction between soaring profits and structural debt has led to wildly different behaviors from the people actually trading the stock.
We're seeing a massive divergence. Like we talked about, Seagate executives have relentlessly dumped their personal shares. Again, 130 sales to one purchase. But on the flip side, highly sophisticated smart money hedge funds have been aggressively accumulating concentrated positions. In fact, all top 10 institutional holders actually added to their positions recently, with funds like AKIM Alternative Investments scooping up a massive $175 million worth.
So what exactly does the smart money see here? Heavy hitters like Avila Global and Duquesne are placing giant bets on the stock's relatively cheap forward PE of 19.5. They're calculating that the explosive earnings per share growth is going to easily outrun those structural debt risks. Basically, they're betting that this AI cycle lasts way longer than the broader market expects.
Section 5. The WDC comparison. As a neutral observer looking at this sector, how does Seagate actually stack up against its main rival in this data storage duopoly, Western Digital?
When you put them side by side, it creates a very clear choice for your portfolio. Western Digital boasts a fortress of a balance sheet with over $7 billion in positive equity. Seagate, meanwhile, offers you a cheaper forward valuation, much higher dividend yields, and of course, that crucial current HAMR technology lead.
So it really comes down to this. The sources suggest Seagate appeals way more to risk-tolerant investors who want income and immediate aggressive AI tech exposure. Conversely, Western Digital provides a structural safety net. It's for portfolios that simply cannot afford the risk of a cyclical downturn, even if it means paying a slight premium for that peace of mind.
As the AI storage supercycle accelerates into the future, the ultimate question remains: does Seagate's incredible pricing power, exclusive tech moat, and massive cash flow actually justify the deep risks hiding in their debt? Do you side with the executives selling their shares or the hedge funds buying them all up? Definitely something to chew on. Thanks so much for watching this explainer, and we will catch you in the next one.